We've been following the energy sector as crude prices have jumped recently amid rising tensions in the Mideast. ExxonMobil shares trading near an all-time high. So how should investors be thinking about energy stocks? For more, we're bringing in Neal Dingmann, managing director at Truist Securities. And Neal, of course, today oil is down because we're getting what people are seeing as disappointing news, or lack of news, I guess, out of China. So first, I guess, talk to us about oil prices versus the oil stocks themselves, and what kind of correlation that we're seeing.
Sure. Thanks for having me. I think what we're seeing, and you mentioned even Exxon, not only I think in energy, but in the overall sector, we're seeing a bit more risk off these days. I'm just surprised. I've been out a lot talking to many investors, and I just find it quite surprising how consensus, I would even call it bearish, investors, energy investors are on oil, yet they still remain quite bullish on gas. So to me, when you have days like today, the risk off, as you mentioned, I think not only from China, but just less geopolitical tension going on out there, or perceived less geopolitical tension. It's not surprised to see some of the more volatile names getting hit harder, and then the Exxons and some of the other higher quality names holding in better.
Neal, there was an NBC report that dropped reporting that Israeli officials still considering a range of options, and that could include hitting Iranian oil facilities. If that happened, Neal, and I'm sure your clients are asking about it, what would be the economic impact, the sentiment impact?
I mean, the impact, I think, would be very quick and quite severe. I think you're talking about immediate 10%, potentially even 15%. You think about, not only what Saudi accounts and the Middle East accounts for existing, but the amount of voluntary production that they continue to have offline, which could, add to that. So again, if all that supply starts to come off very, very quickly, I think what investors realize is the U.S. is not going to be able to make that up in a short amount of period, and thus, as such, I think you have prices go up very quickly.
And is that potential upside risk a reason to hold the oil majors right now, Neal?
I think that, but I think more so, I just think the amount of supply is going to be limited out there. Even if demand is not as high as maybe hoped, I still think it's going to be stable. So to me, the reason to hold the group is it's hard to find a sector where you see better shareholder return in the form of both dividends and buybacks than you do most of the energy stocks these days. So again, I probably find myself maybe a little more cautiously optimistic, finding more higher quality names, but yet a lot of these names are names that can, if you add both the share, both dividends and the stock buybacks, you're talking about upwards to 10% is what they're paying out.
And so, Neal, as you screen for those higher quality names, Diamondback Energy, is that another name that would fit the bill?
Absolutely. That's my favorite. I mean, and what's the key behind their success? They're the lowest operator. You mentioned Exxon. I mean, Diamondback's they're pure Permian, based out of Midland, Texas. Their break even is in the mid-30s. So again, yes, they would love for prices to be higher like every other energy company. But even if prices come down once again to the mid-60s, Diamondback is generating a ton of free cash flow. And I think you'll see them continue to pay a very strong dividend and continue to buy back material amount of shares.
Now, one of the interesting things I picked up in one of your notes recently is you talk about that balance between that payout and having low leverage on the balance sheet, low debt, paying and maybe using some of that free cash flow to pay down that debt instead of shareholder returns. How are you thinking about what is more attractive in this environment?
It's a great point, Julie, because what's been interesting is 3 or 4 years ago, investors in my space, energy investors, were comfortable with at least 2 times, if not 3 times leverage. And now a number of investors get nervous with even 1 times leverage. So again, I think for most of my companies, I would prefer that they're at least under 1 times. But once they get under 1 times leverage, I would hope that they would lean more into shareholder return. But again, there's a number of smaller companies that currently today have around 1.5 or maybe a little bit more times leverage. I prefer that those companies focus primarily on debt repayment until they get closer to sub 1.
Neal, always great having you on the show. Thanks for joining us.
Thank you all.